stocks trade firm on the back of a good crop of earnings reports, but global uncertainties reign in the optimism. Realty and metals lead the gains today, while utilities and healthcare drag. Hindustan Unilever misses street expectations on volume growth, revenue and margin, but analysts expect margin to recover going forward. The Bajaj Finance stock bucks up after its Q4 performance beats estimates, and while it points to some moderation in margins ahead, the growth outlook remains promising. Godrej Consumer may seal a deal to buy Raymond's consumer business, sources tell CNBC-TV18. The move can give Godrej a significant presence in the fragrances and sexual wellness categories. And stocks of life insurance majors HDFC Life and SBI Life swing in opposite directions post their earnings that reveal a stark contrast on Q4 growth and outlook due to their business mix. Hi guys, good afternoon and welcome to Business Lunch. There's clearly a lot to talk about, but first up we have the Hindustan Unilever management addressing the press, so let's go across to that.
Ahead of the market, leading to handsome market share gains. Full-year EBITDA margin remained healthy at 23.4%. Earnings per share grew 13%. Amidst record levels of commodity inflation, we have dynamically managed our business to grow our consumer franchise and protect our financial business model. Let me take you through some of the highlights of this fiscal year. Starting with our divisions, this has been a stellar year for our home care business with 28% revenue growth and volumes growing in near double digits despite significant commodity inflation. Surf Excel became the first home and personal care brand in India to cross $1 billion turnover mark. Through our relentless focus on market development, we have scaled home care liquids portfolio to over rupees 3,000 crore in this fiscal. Our beauty and personal care division grew competitively at 12%. More importantly, we grew volumes despite a mid-single-digit decline in market volumes. Growth was led by our premium portfolio. Despite our brands, Lux and Pond's crossed 2,000 crore turnover each, taking the tally to 5 BPC brands in this club. We have also made good progress in transforming our portfolio towards high-growth demand spaces. During the year, we launched 3 new premium beauty brands and also forayed into health and well-being category. Moving to F&R, our revenues grew 5%, led by strong performance in ice cream, coffee, and foods. With our focused market development actions, HFD continued to gain penetration and market shares handsomely. Tea widened its market leadership versus our nearest competition. Ice cream delivered strong performance on the back of impactful innovation and activations. During the year, we divested our salt and atta business in line with our strategic portfolio choices. We are a powerhouse of big brands that traverse the minds and hearts of our consumers. We have total 19 brands, each clocking over 1,000 crore turnover, which contribute to more than 80% of our turnover. Doing well by doing good is fully ingrained in our business. We have reduced CO2 emissions by 97% versus 2008 baseline. We collected and safely disposed over 1 lakh ton plastic waste during the year. Through Hindustan Unilever Foundation and its partners, we have delivered a cumulative and collective water potential of over 2.6 trillion liters across thousands of villages, which is more than the drinking water needs of India's entire population for 2 years. We are committed to sustainable sourcing of our agri raw materials. In this fiscal, 95% of our paper and board packaging, 82% of our tomatoes, and 69% of tea came from sustainable sources. Our community development initiative, Prabhat, has reached over 9 million people. Project Shakti, which was piloted in early 2000s, now empowers around 1.9 lakh women entrepreneurs across thousands of villages. To summarize the full year results, we delivered yet another year of strong all-round performance. Growing at 16% was significantly ahead of the market, and we added about 8,000 crore to our top line. Our bottom line performance was very healthy with 13% EPS growth. We were the best ESG-rated Indian FMCG company by leading rating agencies. Considering our strong performance, the Board of Directors have proposed a final dividend of Rs 22 per share, subject to approval of shareholders at the AGM. Together with the interim dividend of Rs 17 per share, the total dividend for the year amounts to Rs 39 per share, a 15% year-on-year increase. Let me now shift focus on March quarter performance, and I will start with operating environment. Inflation moderated sequentially, although commodities remain elevated versus long-term averages. FMCG market growth showed gradual improvement with rural slowdown bottoming out. Total FMCG market volumes, which were declining earlier, have now become flat. While rural volumes continue to decline, the extent of decline further reduced in this quarter. In this context, HUL delivered another quarter of competitive growth. Our turnover grew 11% with underlying volume growth of 4%. EBITDA margin at 23.7% remained healthy. Net profit grew 10%. Our gross margin improved sequentially by 120 BPS. We continue to invest competitively behind our brands and stepped up A&P investments by 80 BPS versus December quarter 22. Talking about segment performance, Home Care delivered another strong performance with 19% revenue growth. BPC grew 10% with broad-based performance across categories. F&R grew 3%, led by foods, coffee, and health food drinks. We strengthened our market leadership in tea. However, we had a marginal sales decline as category witnessed consumers downgrading due to higher inflation in premium teas vis-a-vis loose tea. Margins for all three segments remain healthy. Talking about some of our innovations, Novology, our new skincare brand in Masstige beauty segment, was launched during the quarter. Lux Bath Range, Millet Horlicks, Lakme Mousse, exciting flavors in ice cream, and a new hair care range in Tresemme and Dove were launched during the quarter. Now moving on to the outlook. Looking forward, the near-term operating environment is likely to remain volatile with weather-related uncertainties and risk of global market slowdown. Price growth will tail off further due to lapping of high base and sequential reduction in prices. We expect volumes to recover gradually due to high levels of cumulative inflation and the fact that consumer and consumption habits take typically some time to recover with a lag. In these circumstances, we will continue to manage our business with agility to grow our consumer franchise whilst maintaining margin in a healthy range. Our focus is on ensuring right price-value equation for competitive volume growth, building back gross margin, and stepping up A&P investments. From mid to long-term perspective, Indian FMCG sector continues to be very attractive. Favorable macros, coupled with low FMCG per capita consumption, continue to provide huge runway for growth. Our focus remains on delivering 4G growth that is competitive, consistent, profitable, and responsible. With this, I complete my prepared remarks, and now we'll take questions.
Hi, gentlemen. Firstly, Mr. Mehta, lovely to be here, and congratulations on such a great stint so far. We really miss you going forward. But I did first ask you about the demand outlook. Now, the past, we saw Tata Consumer Nestle delivering strong growth, but here a slight miss on our estimates in terms of volume and revenues also that we saw. Just wanted to understand the demand outlook. Is that continuing to remain challenging? Are you seeing any uptick? And give us a sense of both rural and urban as well. Rural, is there still a challenge? And what's the outlook, especially given the heat wave, unseasonal rains? There are concerns of El Nino as well. So what's the outlook there?
Yeah, thank you for that question, and it's been a pleasure interacting with all of you now for the last 10 years, and this is my 39th and last quarter at the helm of HUL. You know, first let me explain the annual numbers and then I'll come to the quarterly numbers. If we take a look at the market, the headline growth has been about 8% and the volume growth has been minus 4%. So remember this, 8 and minus 4. The difference between the two is the derived price growth, which is about 12%. Now 12% has been unprecedented. We have not seen that kind of price growth. In this context, HUL has delivered 16% top line as against the market growth of 8%, and a volume growth, underlying volume growth of 5% against the market being negative minus 4. So you can very clearly see that we have outpaced the market as far as the year is concerned. Yeah. Then when you look at this from an urban and rural lens, the urban market has grown at about 11% top line. Rural has grown at 4%. I'm still on an annual basis. And the volumes on an urban basis has been about -1, whereas rural has been -7. So you can see there is more stress in rural, yeah, but on an overall basis, it's been absolutely a brilliant performance by HUL. Then let's go to the quarter. Now this is a heartening thing. Against an 8% growth, what the Nielsen read says, all our categories put together, the last quarter the growth has moved to 11%. And the volume, which used to be -4, has become flat. And both urban and rural have improved by about 300-400 bips, with a consequent reduction in the negative volume growth. Yeah? So that's the story. Now in this context, remember, the total volumes are flat. We have delivered a 4% volume growth, again outpacing the market. And then we come to our top line growth, which is 11%. Now here I want you all to understand a bit more nuanced number. Our 11% is the headline growth and the volume growth is 4%, so our price growth is 7%. Whereas you look at the market, it is 11% top line and nearly flat volume growth. That means 11% price growth. Ours is 7% price growth. Now let me explain what is the probable cause. Why is my price growth lower than the market? In the previous quarters, our price growth were more or less similar to the market growth. Yeah? Now, he has explained that the commodity prices have started moderating. That means we have stopped taking more price increase at an aggregate level. There are some commodities where the price increase is still there, but in many we have taken a price reduction. Yeah? So our growth, price growth has come down. So what happens when you stop taking a price growth, then after a year, the price growth disappears. Yeah? Now, when we sell, our accounting is based on what we sell to our distributors. The market captures based on what the trade sells out. Right? So there will always be a lag. So even the market growth going forward will come down. The price growth will come down. And when you would recall that 2 years back, when this hyperinflation came in and also we were still in the midst of COVID, we had set for ourselves twin objectives. One was we will increase our consumer franchise, and second is we will protect our business model. Now we have seen outpacing the market an unprecedented share gain. Yeah? The second important bit is if you look at EBITDA, which was at a pre-COVID level at about 25%, is still at a very decent level of 23.4%. Yeah, and in the last few quarters, sequentially, our EBITDA, our gross margins have improved. We are investing more behind the market, and our EBITDA also sequentially is improving. So we can look back and say that in this very turbulent environment, we have met our twin objectives.
Right. And what about the outlook on rural also, given the concerns?
The rural again, it used to be -7% volume growth for the full year. For the quarter under reference, it has become -3.
Right.
So it is progressing. It is still negative volume.
Yeah.
And if we have a good monsoon, I think the government has done a phenomenal job in terms of capex spending. Yeah. And if we start getting a multiplier effect of that with a good monsoon, and if our GDP growth rate, which on all account, all estimates today, it would be anywhere between 6 and 6.5%, I think we should start seeing first the negative volume growth plateauing, and then hopefully starting to go up.
Okay.
If you would recall in the previous years, we used to monitor that a rural growth has to be higher than urban growth.
Open, yeah.
Yeah, we are still far away from that, and it is understandable because the rural incomes are much lower on an average basis. The commodity prices have been very high, but if things stabilize and the prices go down, we will pass on the benefits to the consumers, and we should start seeing the volume improving.
Okay.
time period? Because you did mention gradual recovery in your speech.
That's right, because it is very difficult to predict the commodity prices, right? Right? Exactly. Exactly. If, say, there was if, for instance, if Russia-Ukraine war were to settle down, yeah, peace were to happen, I would believe there would be a clearly softening of commodity prices. And we are very clear, we believe in price-value equation. If commodity prices come down sharply, we'll pass the benefit to consumers.
Right.
And then we'll start seeing the volumes go up.
Right. Actually, that was what I wanted to follow up on. Some price reductions we saw in the skin cleansing, but I think the laundry segment still saw some inflation. So I just wanted to understand, while I understand that it's still volatile, do you think that price hikes are sort of behind us because it's relatively eased?
Because you see the price at an aggregate level, price hikes seem to be behind us unless there is another spurt in commodity price.
Okay.
Yeah, because if you would recall in the previous quarters, we've seen a price hike as much as 12%, whereas now it has come down to 7%, and it will progressively go down if the commodity prices, they don't spike up again.
Do you have an estimate when we can return to seeing volume-led growth?
First is, our volumes are growing.
No, but I mean, right now it's still price-led on an overall basis.
Yes, but you see the equation changing?
Yeah.
It used to be somewhere in the vicinity of 11-12%.
Right.
Our volumes were 4-5%. Now it is coming down. But I said that for meaningfully to volumes to go up, we should start seeing commodity prices not just moderating, coming down, so that companies like ours can pass the benefit to the consumer. That's when the volumes will move up.
I want to know something on the HFD and the tea segment. That was a bit subdued in terms of growth in the last couple of quarters as well. On ground, are you seeing something in terms of a sign coming in from that we could see stronger growth going forward from here? Could we expect better revenues coming in there?
That's a good question. Yeah, we have diverse categories, and different categories have different raw material base. Tea was one of the first categories way back in 2020 when the commodity prices shot up significantly, right? Now, if you look at today, we don't have a price growth at all in the tea category. Yeah, so it is a very different cycle that it is going for. But the nuanced view is that there is a difference in price between the premium teas and the teas which are loose teas.
All right, that is the HUL management talking us through their performance as well as how they see things proceeding. On the rural picture, they are saying that while we are continuing to see declines, it is still a negative volume growth. The extent of the decline has been contained. It used to be -7%. It's now at -3%. So things are, getting a little better. Inflation has moderated as well. They're not really giving us a, volume outlook, which I guess fair enough, because like they said, for volumes to really go up significantly, we will have to see a cut in commodity costs, which they can then pass on to the consumer. The stock really not taking any light of these comments. It's still down 1.6%, but that is the management of HUL talking us through where things are. The good news is that it looks like the rural picture is perhaps bottoming out now. So that is what we're tracking. But with that, it is time for a short break on the show. When we come back, we're going to get you a deep dive into the National Medical Device Policy approved by the Union Cabinet. On the other side, stay tuned.
%100% happiness with SBI Home Loans. Zero processing fee at 8.50% onwards. Apply today. Call 1800112018. Visit homeloans.sbi.
तेरी रोशनी हूं मैं, किसना
ट्रेड ट्राई 5 पैसा। ऑर्डर छोटा हो या बड़ा या कार्ट में पड़ा, कोई वैल्यू या सेगमेंट या कोई भी टाइप, ब्रोकरेज को लेकर अब नो मोर हाई। और सुन, 2 लाख के स्टॉक्स या 2000 इन्वेस्ट मर्जी से करो यार। ना लगे कैलकुलेटर, ना लगेगा पेन, अल्ट्रा ट्रेडर पैक से होगा ब्रोकरेज सिर्फ ₹10।
कमीशन की टेंशन छोड़ो, 5 पैसा से रिश्ता जोड़ो। विद 5 पैसा's अल्ट्रा ट्रेडर पैक, ब्रोकरेज होगी सिर्फ ₹10 फ्लैट। बीट दैट।
ऐसे करते हैं ट्रेड।
सोच मत छोटे, इंस्टॉल मार।
Investment in securities market are subject to market risk. Read all related documents carefully before investing.
कमाल की कार है ना
सर। कमाल की कार के लिए कमाल का पेट्रोल भी चाहिए,
एकदम टॉप का,
जो हमारे इंडिया में मिलता कहाँ है।
अरे सर, प्रीमियम कार्स के लिए इंडियन ऑयल ने बनाया है 100 ऑक्टेन वाला देश का सबसे प्रीमियम पेट्रोल XP 100। इंडियन ऑयल, पहले इंडियन फिर ऑयल।
हमारी प्रार्थना होगी स्वीकार।
Zedlac Premium Agarbatti and Dhoop, official prayer partner, Delhi Capitals.
Hey buddy. Hope you like them.
Introducing Apollo Alpha. Add more thrill to your beast.
अभी तक मटेरियल आया नहीं।
पैसे नहीं है।
अच्छा,
यूप्रो कैपिटल का ग्रोएक्स ऐप है ना, अब आपको भी मिल सकती है नॉन स्टॉप बिजनेस करने की आजादी।
इतनी जल्दी?
Welcome back. You're still tuned into Business Lunch. And an important story, the Union Cabinet has now approved the medical devices policy, which aims to increase India's share in the global medical devices market. Ekta is here at the big wall with all of the details on this policy. Ekta.
Thanks for that. Well, yes, the government has approved the National Medical Devices Policy of 2023. The policy, which contains 6 strategies, is expected to help the sector grow to $50 billion from the current size of $11 billion in the next 5 years. So what does India need? Why does India need a medical devices policy? One of the key reasons is to encourage indigenous production in order to reduce import dependence. Today, 70 to 80% of medical devices in India are imported, with it steadily rising over the last 5 years. As of FY22, imports of medical devices had jumped 41% year-on-year to over 63,000 crores. Today, we import around 8,400 crores of consumables, more than 6,000 crores of IVD reagents, over 3,000 crores of implants and disposable medical devices each, and over 1,200 crores worth of surgical instruments, all of them having grown over the past 5 years. But the lion's share of our medical imports, which is dominated by MNCs, is high-end medical devices such as MRI, CT scans, robotic surgery machines. Currently, electronics and equipment, the segment under which it is categorized, comprises of around 64% of the total medical device imports, having grown from over 21,000 crores to over 40,600 crores in just the past 5 years. India has traditionally imported medical devices from USA, Germany, Singapore, Netherlands and China, with the US being on the top of the importers list. However, there is now a growing dependence on India's focus and dependence on China. In the past 5 years, imports from China have risen from 4,418 crores, which is 4,418 crores, to over 13,500 crores. As of FY22, China comprised of around 36% of our total imports and have seen a strong surge, especially during the pandemic. India has been trying to reduce its dependence on medical imports. The government in 2020 had, in fact, approved the PLI policy worth over 3,400 crores for medical devices and setting up of 4 medical device parks. Until now, a total of 26 projects have been approved with committed investments of around 1,206 crores, with over 700 crores of investments in fact being achieved. The government is aiming at high-end medical devices, with 14 projects producing 37 products being commissioned, such as MRI, CT, mammogram, high-end X-ray tubes, etc. 12 more products and 5 more projects are in the pipeline. Lastly, the latest policy aims to build on the PLI scheme. The policy will aim for regulatory streamlining, enabling infrastructure, focusing on R&D and innovation, and human resource development, amongst others.
All right, Ekta, thanks a lot for getting us all of the details there. By the way, Bajaj Finsub's Q4 numbers flashing on your screen now. The stock at the high point of the day, revenue up around 25% on a year-over-year basis. It's come in at 23,625 crores versus around 18,600 crores that we had last time. The net profit has seen a rise of around 31% versus last year. The stock, like you can see, has moved up even more and is the top gainer on the Nifty right now. So holding up quite well there. But we are going to wind down on that note. Mid-cap radar comes up next. They're going to take all of the action forward.